Hello, I'm Peter Herbert, and welcome to the last of our 2023 short financial reporting and auditing CPD webinars, which this month is going to look at the topic of audit sampling. Last month, November 23, the Financial Reporting Council published a thematic review on sampling as it's applied in the larger firms, and we thought it might be helpful to summarise some of the key findings from that thematic review and also run through one or two of the more common questions we get about sampling on courses and on reviews. So there is a thematic review, as I say, published in November 23. It kind of compares and critiques the approaches to sampling adopted by the larger tier one firms, of which there are 7. And it also draws on feedback from relevant audit quality review, so FRC inspection visits in those larger tier one firms. Whilst approaches will differ across those firms, what the thematic review comments on is that they have all got methodologies based on the audit sampling guide of the AICPA, the American Institute of Certified Public Accountants. In different sections of the thematic, what the FRC do is they compare and contrast and comment on approaches adopted for sampling in respect of tests of detail, tests of control, and tests on IPE, information produced by the entity, and attribute testing. I think of all those, the one that I guess is most relevant to the slightly smaller independent firms that we work with tends to be tests of detail, and that's what we'll focus on here. It also discusses the document The Future of Sampling in Tests of Detail with the advent of tools like audit data analytics. I think for some firms going forward, some of the larger firms going forward, samples for tests of detail will very much become a test of last resort. But for many firms, I think sampling will be around for some time to come. Okay, let's look at some observations then, if we could, from the thematic review. It firstly comments on the fact that for all those tier one firms, they will use sample size calculators, factoring in inherent risk assessments and also the level of evidence obtained from other audit procedures. And that, I think, probably is an aspect which applies to all firms, doesn't it? Generally, if you're using a standard off-the-shelf audit methodology like the Cronin-Ryan methodology or the Mercier methodology, that's absolutely the way that the sample size calculator that you will use will work day to day. The report flags that there's often weak evidence of key judgments in respect of sampling on the file. And that, I think, does very much resonate with me. We do often, don't we, think about key judgments involving things like accounting policies, accounting treatments, but from an audit point of view, you can absolutely be making judgments in relation to things like materiality calculation, in relation to things like your sample size. And if you are making those judgments, really important, I think, to make clear on file why you've reached the conclusion you have in those particular areas. Really big issue for the larger tier one firms, really big issue, I think, for smaller firms as well, in terms of their audit documentation. Talks about the fact that firms will generally place significant reliance on other procedures, possibly with a view to having a smaller sample size for a substantive test of detail. And that would, again, I think, be a point that applies very much across the board. Sometimes it's not really clear why a particular level of reliance has been taken or credit's been taken for the other procedures. And that, again, from a documentation point of view, I suppose, is really important to make sure that you do get right. Many firms that we work with will take credit for substantive analytical review. Remember, to really be able to take credit for substantive analytical review, it does have to be based on an expectation. It does have to be predictive. The point they make is that what some of the larger firms do is, in terms of the amount of reliance for substantive analytical review that they will take, that might be linked to their tolerable discrepancy for that analytical test. Remember, if you're doing a substantive analytical review, what you've got to do is to articulate what level of discrepancy you'll tolerate between the client's figure and your expectation without doing follow-up work. What they're saying here is that where that tolerable discrepancy is smaller, that gives you the ability to place more reliance Where the tolerable discrepancy is larger, less so. Interesting observation, and one I think that could be relevant to many. And just as, I guess, in terms of comparisons of the sorts of sample sizes the different firms come up with in that tier one sort of sector, yeah, they're making the point that it is difficult to compare. There is actually one interesting statistic, though, within the document where they talk about a situation whereby where you have, for example, got a population for a test which is 27 times performance materiality, where the area concerned is an area of significant audit risk, and where no reliance is being placed on, for example, tests of control or analytical review, they were commenting that for the firms in tier one, you would generally end up with a sample size of between 71 and 79. Now, that was really interesting to me from a couple of points of view. First of all, really interesting that across all the tier one firms, in that situation, you'd end up with just similar number for your sample size for your test of detail. That also to me feels like quite a big number. And we're certainly getting soundings and have for the last 2 or 3 years that I think when it comes to tests of detail based on sampling, bigger firms are going for pretty big sample sizes these days. And yeah, that stat to me very much kind of bears that observation out. Here's an interesting graphic that I found in the document, which links back to the point about sample sizes for tests of detail being linked to risk assessment and also being linked to alternative procedures. What they do actually in the document, in the graphic there, is they frame it in terms of what they call confidence level, or CL. Now, confidence level is not a term we use, is it? Lots day to day. It's the percentage probability the auditor will be required to have that a balance isn't materially misstated. And I guess what methodologies will generally tend to do, they'll take that confidence level and convert it then into a sample size. And as you can see here, what we're saying is the level of confidence required in a particular area depends on the level of risk, higher level of risk, higher level of confidence. And then beyond that, in terms of the level of confidence required from the test of detail, that will then be determined by how much reliance you're placing on other procedures like tests of control, substantive analytical review, and data analytics. This example is based on a presumption of a high level of risk, reliance on controls only, and then the residual test of detail, that's going to give you a confidence level of 30% that would then get translated into a sample size based on the calculator that the firm were using. And I think what's interesting to me is that very much, I think, links in my mind to the idea that when it comes to tests of detail and samples for tests of detail, that I guess is the kind of the last bit of evidence you're going to gather. You're going to think about your controls tests, think about your substantive procedures, think about your data analytics, and then I guess the residual risk is picked up by the test of detail. And that I think is the way it works, isn't it, across all the different firms that we certainly work with day to day. I guess there is there, though, an imperative to think about the audit being an iterative process. If you're presuming a sample size of 10 or 20 or 30 or 50 based on a test of control working or a substantive analytical review procedure working, and then it transpires when you come to the evidential section of the audit that that test doesn't work, you do then need to loop back, reassess your approach, and that might then mean for your test of detail, you end up with a larger sample size in practice. Okay, some other observations from the paper. Care should be exercised when picking key items in a stratified sample. The point they make here is that what some firms will generally tend to do now is make bland remarks about we might, in terms of a stratified sample, in relation to significant items, look at everything above 50% of performance materiality. Why? Now, that again could be an important judgment that might need to be made really clear on the file. One thing I know that we're more and more focusing on from a review point of view is not only are firms picking the right sample size or going for the right sample size based on the sampling methodology, but are they actually approaching sampling in a way whereby each item has got an equal chance of being picked when you are looking at the residual population and you are then looking for a sample of items from within. And that, I think, very much comes across from the paper. The presumption here is, I think, that what the larger firms will do is they will make really clear on file why every item and how every item in the population has indeed got an equal chance of being picked. What they're flagging up here is that random sampling is so often preferable to haphazard sampling when it comes to that, and actually, as an approach, should these days be more often achievable and more often approach, therefore, that firms would gravitate towards. Interesting from my side that there's a whole section of the document dedicated to sampling methodologies approached when testing IPE, information produced by the entity. I guess this thing I would want to really emphasize there from my side, as someone that works probably more with the slightly smaller independent firms, is we do constantly, I think, beat the drum in terms of reminding people, if you are using IPE to basically inform the audit work you're going to do in a particular area, do ask yourself, do we need to actually validate and verify the information produced by the entity for the audit we're doing, and what's our approach going to be to that? That, I guess, will very much depend, won't it, on risk. If the client's producing you a bespoke report to inform the testing you're doing in a particular area, maybe based on a spreadsheet, there might be a higher risk of misstatement, and that means that IPE needs to be tested in a more robust way. If you're quite simply placing reliance, maybe, I don't know, on a debtor's print coming off Sage accounting system, that's probably a document which the client can't easily manipulate. There might be a lower level of risk and less work therefore needed in that area in terms of the testing that you will actually perform. I guess what I'm saying here, though, is given the document dedicates an entire chapter just to that area, it does really reinforce in my mind the need to be focused on IPE and the need to test integrity sometimes before we then get on to the actual way that information underpins figures in the financial statements. And lots of coverage as well about how you might pick samples for tests of control. It talks about the fact that for the larger tier 1 firms, you can basically get, in some situations, enhanced reliance on controls testing to reduce your sample sizes for your substantive tests of detail. The sense I certainly have talking to firms about the standard off-the-shelf methodologies, the ones I've already referred to, is the inbuilt calculators within those systems don't seem to give you huge payback from testing controls. And I think that's one reason for many firms why fundamentally they don't do that much on a day-to-day basis. Okay, so a few observations from me there about the document. Well worth having a look yourselves, but that hopefully draws out some of the key observations that could be relevant to any firm. Let's finish off, if we could, by looking at some of the more general questions we get asked day to day about sampling and how it should be approached. Okay, the first one, I thought the FRC had banned sample size caps. Yeah, interestingly, in the document, no mention at all of sample size caps being frowned upon. You may remember us talking quite a bit last 2 or 3 years about the fact that some of the FRC review documents they've published in recent times have said that when it comes to the firms that they review, any firm auditing a public interest entity will of course be in scope for an FRC review. They do very much frown on sample size caps when it comes to audit testing in areas of significant risk. There's no rule in the ISAs that says that's a no-no. There's no blanket ban from the FRC on sample size caps. But as I'm sure you'll remember from a number of the sessions we've run in recent times, certain of the standard methodologies that firms do use day to day have introduced a removal effectively of caps based on those FRC comments. And that's therefore, I think, from those firms' point of view which use those methodologies, given rise to them needing to think very carefully about the approach, about the assessment of risk in various areas, just to ensure that sample sizes aren't completely ridiculously high and completely prohibitive in terms of the way that the audit's approached. Given all the noise about that topic and given all the conversation about that topic in the last 2 or 3 years, this was probably going to be a great chance for the FRC to nail that particular point. But interestingly, no comment at all on the removal of caps, and we are where we were therefore in relation to the way that that works on a day-to-day basis. I think that's something which I wanted to raise. How much credit can you actually take for tests of control, and are they worth performing? How much credit can you take for substantive analytical review, and is it worth performing? And this, I think, links back, doesn't it, to the previous question, in the sense that if we are in a world whereby our methodology has removed caps and we're looking down the barrel of a gun maybe for a transaction test on income, transaction test on expenditure, where we've got a really big sample size, we might have a real appetite to want to actually place reliance on other procedures. And then our final port of call, going back to that earlier graphic, would indeed be our test of detail. I think I would say with that one, the audit methodologies, the sampling methodologies, the sample size calculators will build in reliance that you can place in those situations. My comment would be, from an analytical review point of view, more scope to take credit for it where it's predictive, less scope where it's not. And I think from a test of control point of view, now I do very much encourage firms to embrace tests of control. As I mentioned a few minutes ago, I do find that based on the standard tools, the built-in tools, you don't get huge amounts of credit. And I guess in terms of the audit strategy that you adopt day to day, tests of control have got to be viable, as well as being things that will work. So yeah, that's my observation there. Some for both. How much you will be able to and how much you do rely on other procedures obviously is going to be a moot point in a situation by situation basis. I think that's a very interesting question we got asked recently. If a proof in total test works very well, is there need to sample at all? Potentially not. Remember that paragraph 18 of ISO 330 does say that you've got to do some substantive testing for every material balance, class of transaction, and disclosure in the accounts. But yeah, absolutely. If your proof in total, your analytical test works really well in that situation, if you've got a very small tolerable discrepancy and you're within that tolerable discrepancy, I would say be bold. One point I would comment on, though, from ISO 330 is that when you are doing a test in an area of significant audit risk, some tests of detail will be required. And that's, I think, often a very interesting point, isn't it, around the way we approach the audit of income, the audit of revenue. If you've not rebutted the presumption of fraud in revenue recognition, then that will mean that revenue will be a significant risk. And therefore, in that area, you'll need to do some tests of detail, even if analytical review works really, really well. Where you've chosen to rebut the presumption of fraud in revenue recognition, that will therefore mean that if you're doing analytical work in that area, it might well be that you can just rely on an analytical approach alone. So I think that, again, does vary depending on the situation. I guess in my mind, in terms of making audit efficient, two things that are worthy of really important consideration: are we taking the credit we could take for doing things like analytical review, doing things like tests of control? Are we in a particular section of the audit file coming up with too many tests? Have we got 10 tests where possibly 3 would do? And then as a final point, are we getting our risk assessment right? And again, a point I've made lots all the way through the last year in relation to ISO 315 revised. It does give people the chance to really think about the approach and possibly leverage greater efficiency as well as greater effectiveness in terms of the audits that they're doing on a day-to-day basis. Final question is this one, which I got asked recently. When performing a trade creditor test, can you really work at your sample based on the population size? I mean, I think the start point there probably would be no. for the simple reason that I guess when it comes to your trade creditor test, if you're thinking about the way that directional testing works, you're testing for understatement, you're testing for completeness, you're testing for what's not there. But if you're therefore starting from the premise of the population, that's probably the wrong place to start. And I would therefore say, look at the key suppliers, look at your purchase ledger activity report as the key start point for working out which suppliers you're going to have to look at and test to make sure that creditors are indeed completely captured. And it might be for some audits you do where perhaps there's a very small number of suppliers. That will be a really obvious and intuitive way to go. And that might therefore be very important jobs that you bring to bear in terms of picking your sample. You're not using a calculator. But I guess for many organizations that you audit, there might be a large number of suppliers. And I think therefore in that situation, what firms probably would do, just to give them a sense of possibly whether they're on the right sort of track and picking the right sort of number of suppliers to do a test on in that particular area, they might indeed use a calculator. They might indeed start off with the total population of trade creditors. They might indeed look at the ones that exceed sort of performance materiality and then perhaps pick a sample from below. So I think firms probably would do, but if you're thinking in that area, it makes more sense to go off piste and think about it a bit more intuitively about how many and which ones, because you are testing for what's not there. That to me is logical. But from a review point of view, if we do see calculators used, we don't have major issue with it. But are you thinking about what's not there? And does that come across really in the way that you plan and perform your test? That's the theme across the board in this area, given that from a directional testing point of view, we focus more in this area on understatement than overstatement. Okay, so there we are. We've had a look at the FRC's thematic review on sampling, tried to draw out a few points there relevant to the slightly smaller independent firms that we work with day to day, and also run through a few common questions about sampling we do get asked and give you a few ideas there about what a response would be in relation to those. Hope that was useful, and a really big thank you to my good friend and colleague Rich Hemmings for his input on this particular session. If you want to make contact, excuse me, please do. Inquiries at insight-train.co.uk and our website there, www.insight-train.co.uk, with full details of our 2024 training program. Good to see you all. Have a great Christmas, and I'll see you next year. Thank you.